Picture this. The stock market is a bustling marketplace, like a giant farmer's market, but instead of fruits and vegetables, we're trading pieces of companies, called stocks. Each stall represents a different company, and the prices of their stocks, like the price of apples or oranges, go up and down based on how well they're doing. Think of it like this. If everyone loves the juicy apples from Farmer Joe's stall, the price of his apples will go up because everyone wants a piece of his success. That's the stock market in a nutshell. It's where buyers and sellers come together to trade these stocks, hoping to make money as the value of their fruit goes up. Now, this marketplace isn't just about the companies themselves. There are other characters that play a big role in how the prices move. These characters are the economic factors, and they can really shake things up. We're going to meet these characters and understand how they influence this exciting market. Buckle up, because just like a day at the farmer's market, things can get pretty interesting. Let me introduce you to inflation, the market's resident price hiker. Inflation is like that character who always wants more money for the same thing. When inflation is around, the price of everything from apples to oranges seems to go up. Now when prices are high, people can't buy as much. This means companies might see slower sales, and that can make their stock prices drop a bit. Investors get a little worried when inflation is high because it eats into their profits. Imagine, you buy an apple for $1 today, and tomorrow inflation comes along and suddenly the same apple costs $1.50. You might think twice about buying that apple. That's why everyone keeps a close eye on inflation. If it stays in check, the market tends to be happier. But if it starts getting out of control, it can really put a damper on the market party. Next we have the banker, who controls the interest rates, like setting the cost of borrowing money. Think of it like this. The banker lends money to the stall owners to help them grow their businesses. When the banker is feeling generous, he lowers the interest rates, making it cheaper to borrow money. Lower rates mean companies can expand, invest more, and potentially earn more, which can make their stocks more attractive to investors. However, if the banker is worried about the economy, he might raise interest rates. Higher rates mean companies have to pay more to borrow money, which can affect their profits. The banker's decisions have a big impact on the market mood. If borrowing is expensive, companies may think twice about expanding and growing. Section 4. GDP, the economy's scorecard. Now let's meet GDP, the economy's scorecard. GDP stands for Gross Domestic Product, and it's like the report card of the entire market. It tells us how much the economy is producing and selling. When the GDP is up, it means the economy is doing well, businesses are booming, and people are buying. A strong GDP usually makes investors happy and more likely to invest in the stock market. Think of it like this. If everyone in the market is doing good business, selling lots of fruits and vegetables, the overall market sentiment is positive. But if the GDP is down, it means the economy is sluggish and people are buying less. This can make investors nervous and less likely to invest, which can cause stock prices to dip. Section 5. Global gossip and corporate earnings. Finally, we have two more factors that add to the market buzz: global gossip and corporate earnings. Global gossip is like whispers and rumors spreading through the market. It could be news from another country, political events, or even natural disasters. These events can make investors nervous or excited depending on what's being said. And then we have corporate earnings, which are like sales reports from each stall. Each company shares how much profit they made in a certain period. Good earnings usually make investors happy, boosting stock prices. So, there you have it. The stock market is like a giant, dynamic marketplace, constantly influenced by a cast of characters representing different economic factors. Understanding these characters and how they interact can help you make sense of the exciting, ever-changing world of the stock market.